And we are back with Tommy Barko of Barko Financial. Earlier in the show, you made a comment about some technology and things along those lines. Is perhaps part of the thing that's helping keep the economy somewhat more stable in these times the fact that people have been able to convert to working remotely, seemingly fairly easy, right?
Yeah, surprisingly, there's been this kind of reinvention in a lot of areas out of necessity. People have been able to work from home. Productivity has stayed up. And if you look at the market, when we talk about the market, most people are thinking the S&P 500, right? We kind of joke lately and say it's the S&P 5 versus the S&P 495 because there's been 5 big technology companies that have carried a lot of this recovery that we've seen. So that's helped stabilize the markets as well. And then the 2 winning sectors are technology by a huge margin, and then consumer discretionary is right there, and that's Amazon. So it's interesting.
To your knowledge, how have people that pulled their money out fared so far this far?
Yeah, so fortunately, we didn't have any clients make that move. So I can't really tell you from experience, but just looking at the performance of the market, I think they probably got hurt pretty bad unless they were out in February when everything still looked pretty good, because it was a pretty rapid sell-off. There was a lot of fear and panic, and then people are still afraid and feeling a little bit of a panic, and they haven't moved back in enough.
Are there any particular stocks that really surprised you this year with how well they've adapted to the conditions?
We take definitely a more broad view of investing, and we do everything in context of a plan. So we kind of joke and say our clients usually hire us to make all that go away, right? They're not looking for the stock tips and the PE ratios and all that stuff. We pay attention to it. The tech companies have been just extremely surprising. And the most interesting thing to me about all of this is, the S&P is up, but the large cap growth space is up just substantially more. It's been very isolated to just those few companies that have really taken off. And the market's been driven by Facebook, Apple, Netflix, and Amazon and Google for years now. And they're still leading the charge in a lot of ways, largely because of this shift as well.
When you talk about the S&P to the average person who isn't an average investor, but they want to learn more about it, possibly get into it, what does that mean?
Yeah, the S&P 500 is an index that you see largely promoted. It's analyzed and followed on the news. When you see them talk about the market, it's usually the Dow, which includes 30 stocks, the S&P 500, which includes 500 stocks, all U.S., and the NASDAQ, which is technology companies, largely in some small cap. So the NASDAQ has done extremely well this year. The S&P 500 is a good metric because it's kind of a broad category, a broad index. It includes those 500 large companies, and there's criteria for being included in that index as well. But most people feel like it's a pretty good measure or temperature on the U.S. economy and markets as a whole.
Have you seen a rise in valuations of pharmaceutical companies as a result of the virus?
Yeah, there's been a big shift in funding towards that space. So healthcare has performed well year over year, but year to date, we feel like it's still lagging a little bit. But the pharmaceutical space, there are 135 vaccines in development right now. And obviously that's all pharmaceutical. Now, who makes money on that? Some of the leading companies have said they'll do it with no profit. So it may or may not translate to stock valuations going up, but it is definitely an area that is interesting. And
what makes the stock market rise and fall? Is it all speculation? Is it just investor sentiment? How does it, for a viewer who doesn't play the market, but it has an interest, or has always been nervous and wanted to maybe dabble their feet in the water a little bit?
Yeah, there's a lot that makes up the value of the market, and supply and demand is probably the simplest way to explain that. All these companies are publicly traded, so they offer shares of ownership in their company, and people assign a value to that based on what they expect, how much earnings that company is going to have, what the sentiment is towards that, maybe things they're developing, things they think will sell, like a pharmaceutical drug like you just mentioned. But I think it's important to remember when we're talking about, maybe people that aren't doing this, that are interested, is when you approach investing, I'd say it's a lot like picking a pain medication, right? If you go to your doctor and say, I'm having pain, I need pain medicine, there is a range of things they could prescribe you, from something over the counter to something you don't want that's going to take you out of this world. And they can't make the appropriate decision on what to prescribe you without knowing what's going on, right? So it's the same thing with your financial life. It sounds great to think you can make money by picking a stock and expecting it to do something, and that's the speculation that you mentioned. And when you speculate, you may win, you may not. But when you invest, you're disciplined, you have a philosophy, you have a plan.
So from a standpoint of investment philosophy, obviously there are some people who treat it kind of like a day at the casino, where they want to pick something, hope it goes up, keep an eye on one or two or a handful of stocks, and they hope that the average of their portfolio rises at a certain manner or level. But what you're talking about is more long-term investment for retirement and things along those lines. Is that what you're talking about?
Absolutely. So you've got trading, which involves a lot of speculation, and maybe is more short-term focused, trying to predict a trend or get in on the back of one. Whereas investing takes a lot of that emotion out, and it makes decisions based on a long-term plan. So it'd be more like a fitness plan, a dietary plan. A financial plan should be the same way, right?
Now, you earlier you mentioned something about the Fed and a change in interest rates, and you compared it to the first SARS epidemic. The Fed itself, they can adjust interest rates and do certain things. How much does what the Fed do have an impact on markets?
Quite a bit, in my opinion. This is widely debated, but I think their response in this case was very extreme, but I do think that it helped. And in the short term, now, for generations to come, you mentioned writing whole books on all of this. We'll see how this plays out for us and our children and our grandchildren, and inflation is going to be a concern, and just the amount that was spent compared to the financial crisis of 2008 is just dramatically different. But the lowering of interest rates and how they were able to back assets and kind of open-endedly buy back things that seem to be having liquidity issues really stabilized the markets and kept us from having a full-blown financial crisis and let us focus more on just the health and the economic impact.
Now, you're physically in there to some extent in the trenches, not necessarily from a day trader standpoint, but and the reason why I bring it up in that way is because there are people who, especially read stuff online, and depending upon one's political viewpoint, there are people who say, well, the stock market itself doesn't truly reflect what the economy. In other words, there are some people who say it's disconnected from the real economy because it's disconnected from in some cases, real lives, what the minimum wage is, unemployment, things like that. Is that the case, or is there a direct relationship between those things? Because I know the market, like you said, is supply and demand. But, for example, we had these big tax breaks, for corporations. And then that resulted, from what I understand, in a fair number of corporate stock buybacks, right?
Yep.
That then drives the Dow up, right?
It does.
So if that drives the Dow up, then the Dow looks at a certain way and everybody goes, oh, the Dow's great, the economy's wonderful. But meanwhile, there's people who are, wages are stagnant or GNP remains stagnant or whatever. Have those other things really remained stagnant, or have some of those things risen as well, from a standpoint of, I hate to use the term, but trickle down or you see what I'm saying? You know where I'm going with that?
Yeah. Yeah, so I think one of the first things you said was kind of mentioning the stock market and comparing it to the economy. Important for people to realize that those are not the same things. The economy is not the market. They are related, but the markets generally precede economic turmoil. They'll sell off. Recessions usually occur before economies recover, and markets will lead economic recovery because the market is forward-looking. So the stock market and the prices on those stocks are all looking past all of this if you want to look at what we're dealing with now.
So they're predictive.
And so, yeah, they're pricing in what they expect to happen. The same is true with an election. We're in an election year, and the market hates uncertainty. But it factors in and prices in what it does know. Over the next 2 to 3 years, everything that's known has already been factored into the market and these individual stock prices.
There are some people who are like, well, if this person gets elected, the stock market will do that. If that person gets elected, the stock market will do that. But the reality is the stock market probably pays attention to the polls, right? The market pays attention to the polls. So the market is already kind of prepared for whoever's leading in the polls to be elected when they're elected, because the polls are what they're basing it on, no? Or am I wrong?
Yeah, absolutely. 2016 is a perfect example. Hillary was leading in the polls and ultimately lost. And that night, the stock market futures went nuts. The volatility really spiked because it was this recalibration. And
it was unexpected.
What we usually say is the market, it doesn't like that uncertainty, but once it has the news, even if it's bad news, it can react to that appropriately and then price that in and move forward. So the same is true this year or in any event like that that's coming. It'll interpret that data, and surprises will make it more volatile, but it's already looking forward and beyond that at this point.
So to close, we know that there's a slew of factors that create happiness, prosperity, financial security in our lives. What are some of the factors that you teach that maybe we don't spend enough time on?
Yeah, I think it's very important to realize, and we make this a core part of what we talk about. It's actually based off of a philosophy called Essentialism. So I don't know if you're familiar with that. There's a book published in 2014. And the general takeaway is 98% of what we encounter on a daily basis and in our lives is just noise. There's only 2 or 3% of things that really matter. So obviously some of those things are family and our faith, prosperity, happiness, those things you mentioned are tied to those things. And so we started realizing, and this was very impactful for me personally, but started realizing for our clients that this is really the key. Identify those 2 or 3 things, 2 or 3% of things that are essential, and go big on those things. Say yes to great opportunities, say no to okay or even really good opportunities. And so you want to do that with your investments, with your financial life. That includes avoiding, like Dave Ramsey says, the stupid tax, right? There are all kinds of tools out there, things that people can use that just don't work to serve things that are really important. So we really try to help people focus on that and then build a plan. The difference between a dream and a goal is a plan, we say. And so you want to have that plan in place to achieve goals. So finding out what those goals are and then just going big on them and staying disciplined are the secrets to success with this part of your life, in my opinion.
Well, Tommy, thank you for joining us. We really appreciate you being on the show. Ladies and gentlemen, Tommy Barko with Barko Financial.
Yeah, thanks for having me.